Ladies and gentlemen, good day and welcome to the H1 FY26 results conference call of Maiden Forgings Limited, hosted by Kirin Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Harshil Ghanshyani from Kirin Advisors Private Limited. Thank you, and over to you, sir.
Yes, thank you. On behalf of Kirin Advisors, I welcome you all on the conference call of Maiden Forgings Limited for S1 FY26. From the management team, we have Mr. Nishant Gaur, Managing Director. With that, I now hand over the call to Mr. Nishant, sir. Over to you, sir.
Good afternoon, everyone. I am delighted to welcome you all to Maiden Forgings Limited earnings conference call for the first half of financial year 26. Thank you for joining us and for your continued confidence in our journey. From our beginnings as a proprietorship in 1988 to becoming a publicly listed company in 2023, Maiden Forgings has evolved into one of India's most trusted manufacturers of bright steel bars, wire, and pneumatic nails. With over 35 years of experience, we cater to diverse sectors including automotive engineering, infrastructure, hardware, and increasingly defense, and even to an extent now the consumer markets. Our 3 advanced manufacturing units in Ghaziabad, with a combined installed capacity of 53,000 metric tons per annum, serve more than 450 customers across India and international markets such as the US and the Europe. The first half of financial year 26 marked a strong phase of operational progress for us. Despite macroeconomic challenges and price volatility in input, we achieved the highest production and sales volume in our history comparable to any H1 results of ours, reflecting sustained customer demand, better utilization levels, and increasing traction from our high-margin stainless steel, bright bars, wire, and others. This performance underscores our ability to maintain operational discipline while expanding our presence across multiple high-value segments. In addition to our progress, we are preparing to introduce 2 new product lines, GI wires and stainless steel machine components, from the next financial year. Both vertical and horizontal expansions carry superior margin potential and further strengthen our presence in value-added product categories. A key highlight during this financial year was our registration as an approved supplier with the Ordnance Factory Board Muradnagar under the centralized vendor registration process. This comes in addition to our existing registration with OSB Kolkata, marking another strategic milestone in our association with India's defense manufacturing ecosystem. With this development, we have strengthened our credentials as a multi-location approved supplier within the OSB network, paving the way for participation in upcoming opportunities with defense sectors such as HAL, NTPC, and other public sector entities. The growing traction within the B2G segment further reinforces our strategy to diversify revenue streams and align ourselves with India's self-reliance and indigenization goals. Another step that states our clear intent of contributing towards this segment was our recent registration with Semilec DRDO. And alongside this, our B2C vertical continues to gain traction, led by growing demand for coil nails sold within India itself now. We are now in advanced stages of expanding this presence to the US and the UK, supported by our plan to establish overseas warehousing to reduce shipping timelines and improve cost efficiency. This initiative complements our broader export strategy aimed at capturing premium markets and strengthening recurring demand across global supply chains. To support this multi-segment growth, we are currently in a significant expansion phase. We are executing a structured CapEx program covering machinery procurement, installation, and the shifting of operations to our new integrated facility. At the same time, we are enhancing working capital to support higher volumes, inventory buildup for new orders, and larger B2G and export-linked contracts. These steps are essential to ensure uninterrupted scale-up as we enter new product categories and serve a broader customer base. We are also making steady progress on the development of our 4-acre industrial facility at Modinagar, located about 25 kilometers from our current site. This modern integrated plant will consolidate two of our existing units, streamline operations, and unlock meaningful cost efficiency. Once completed, the facility is expected to generate annual savings of around 2.5 crore rupees while enhancing throughput and workflow efficiency. Consistent with our sustainability agenda, the unit will include a solar installation that will meet up our maximum energy requirements possible technically through solar energy, reducing our carbon footprint and strengthening our cost structure in the long term. The ongoing plant consolidation and process optimization, coupled with our solar integration, are expected to further improve our cost competitiveness and profitability in the coming years. Our diversified presence across B2B, B2C, and B2G segments ensures business resilience and scalability, allowing us to capture opportunities across different economic cycles. What sets us apart is its integrated OEM grade manufacturing model and ability to serve multiple alloy grades and product types under one roof. Our facilities are equipped to manufacture bright bars, wires, and nails across mild steel, stainless steel, and alloy variants, ensuring unmatched flexibility and quality control. The same precision and consistency that makes us a preferred supplier for Tier 1 automotive and engineering clients also define our reputation in export markets. As one of the few Indian producers of export quality pneumatic and coil nails, we continue to serve high-value clients in the US and Europe while expanding capacity to meet growing global demand. I would like to take a moment to reflect on our recent performance. In H1 financial year 26, despite industry-wide headwinds and pricing volatility, we maintained operational stability and continued our strategic focus on high-margin product segments. During this period, we reported a total income of 111.36 crores rupees with EBITDA of 6.74 crores, translating to an EBITDA margin of 6.05%. Net profit for the half year stood at 2.10 crores with a net profit margin of 1.88%. This performance underscores the strength of our diversified product portfolio, disciplined cost management, and the resilience of our business model amid a dynamic market environment. Looking ahead, our strategic focus remains on scaling our high-margin product lines, deepening our participation in the B2B segment, and expanding our export presence through product innovation and brand building initiatives. With strong customer relationships, a forward-looking growth pipeline, and continued emphasis on quality and efficiency, we are confident of sustaining our growth trajectory and strengthening our position as a premium, innovation-driven manufacturer. In essence, we are focused to build a better future for all our stakeholders by enhancing the production and sales of specialty offerings, while giving utmost importance to R&D so that we can contribute true value to the growing defense technology sector in the near future. The testament to this has been our past months of the current financial year, wherein we acquired multiple B2G segment orders as well as multiple registrations. As stated in the last IR call, the growth in this segment requires patience, but all these registrations and supplies have been building blocks to our credentials in this segment. And with same focus, we are very confident to rebrand ourselves as an organization known for its innovation in the coming years. I once again thank you all for your participation as well as your continued trust in us. I now invite your questions on our performance, operations, and strategic outlook. Thank you once again.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Karthikeyan Sitaraman from HNI Corporation. Please go ahead.
Yes, thank you. Good afternoon, Nishan.
Good afternoon, Karthikeyan.
Yes, I have two questions. One is from the audit financial results. I seen that you have made the advance for the land sale, right?
Right.
Will this end by this second half of this year, or
Yes.
it will be
Yes.
completed by
No. This will end by before March 31st.
Okay, then sure. Okay, so you're planning to reduce the debt, or you're planning for the dividend?
There would be there should be further land sales in January, February, or maximum in the first quarter of next financial year. Okay. So there would be add-on to this figure by March 31st also, and then post that also in the next H1 as well. Okay. So because we have more of assets to be sold once we are consolidated at one place. Okay. And there are multiple assets which are not which would be of no use once we have shifted. So all these would be adding on to it.
Okay.
So there would be multiple additions, and as well as we are doing some fundraise, which is under process right now. So all this combined, once we have realized all this, or in parts as and when we are going, definitely the scheme of things is to firstly to ensure that whatever capex we are doing are well funded in terms that we are installing machines and technologies which saves our long-term costing. So first agenda is that. Second agenda is to ensure like we are introducing 2 new products as well as we are very much aggressively going for B2G now. Like last year was slow because we just started, so we also need to grasp things. So second agenda of after realizing all these funds is that we are already going aggressive. We will be going more aggressive, so we will be needing some more working capital in terms of building the inventories as well as credit terms with the B2G segment as well as our export section. So second objective utilization of those funds would be to in the working capital needed for enhanced operations or enhanced revenue. And third would be loan repayment, debt repayment, to an extent where it doesn't hamper our working capital or the capex, but at the same time, in the end, we would be reducing debt to a substantial amount. That's our calculation, estimate.
Okay, fine, sure. Okay. That's it from my side. Thank you.
Thank you. The next question comes from the line of Prashant Shah, an individual investor. Please go ahead. Prashant, please go ahead with your question and unmute yourself in case if you're on mute.
Yeah. Thank you for the opportunity. So, sir, my question is, what are your plans for forward integration into specialty steel, and how large is the addressable market for import substituting products?
See, Prashant, first and foremost is like a specialty steel we are already doing to an extent. The contribution is minor, that's why we don't mention it like in a big way. The next expansions that are planned recently are GI wires and stainless steel components. The stainless steel components is our forward integration of stainless steel bright bars and wires. We will be making those components out of these two products of ours. For that, we already have LOIs from our existing customers who want to offload some of their components to us so that they can supply it to the tier 1 vendor of auto sector and multiple like defense, oil and gas, these sectors. So that's why we have received LOIs from that and from those customers, and we are going ahead with that. As well as second product like GI wire, again, this is a product for which we already have about 800 tons of monthly market in hand even before installation of that plant. We were doing, for last 6-7 months, we have been experimenting and, to ensure that the quality is at par. We don't have the full setup right now, but we had partial. So we were testing qualities on that, and with, I believe by first quarter of next financial year, we would be having both the products in hand, like sales would be starting. So these are the two primary focus areas in product lines that we are focused on for next 6 months to 8 months, let's say. And specialty, as far as specialty steel is concerned, definitely when we are trying for B2G and defense sector particularly, right? So there the demand for, we are already capable of producing bright bars and wires in those type of steel. But we didn't have that kind of market and we didn't focus much on marketing of that till the last year. But now we are highly focused, and what we see is, what our analysis is, that the maximum traction would come from the defense segment for those steels, as they have huge demand for it.
Okay. And so, sir, how do you view competition in this bright bars and stainless steel wires, and what differentiates us? I mean, your 48-hour delivery model from industry peers.
See, it's not exactly 48 hours, but yes, we are the fastest in the industry because, like we said that in this H1, maybe the revenues didn't increase that much because there was a overall stress on the steel price, and they were the lowest, I think, at a 2016 or 17 year level in terms of pricing. But that being said, H1 में हमने अभी तक का सबसे ज़्यादा volume करा, and that is approximately 17,000 tons in H1 itself, which we have never done before. So it's like exact figure is 16,872 tons. So we have done approximately 17,000 tons, and there is competition, but what sets us apart is that most of the companies in our sector are unorganized. For example, there are numerous processes that we are performing in-house, which completes the entire range of bright bars and wires. For example, we are doing cold drawing, we are doing peeling, we are doing multiple types of annealing, quench tempering treatments, etc., etc. I mean, there would be more than 10 processes that we can perform. Not applicable to every product, but every product has a different process that it has to go through. That's why we have more than 3,000 SKUs. So what happens is, whenever any bigger company, let's say it belongs to defense sector or auto sector or engineering sector, if they are making any assembly or component, they will require multiple types of these products, and they also need high quality checks level. So once we have onboarded a customer like that, okay, which we already have numerous customers like that. So once we have onboarded that customer, so they don't prefer, because their approval process is tough, then their quality parameters are tough to maintain. So they trust that vendor and go for a long-term partnership with them. That is how we have retained customers as old as from 1991 or 92. So that is one differentiating factor, that we have all the capabilities in-house, and we can, deliver the most. Maybe the steel grade itself is not special, but the operations that we are doing, the consistency required, that is special, so that's why it comes under a specialty steel kind of order. So that is one thing. We are organized. We have everything in-house. And if someone has to replicate such kind of model as well as credibility associated with it, it will take minimum 5 to 10 years for them to copy this model. That's why we are quite different in differentiate. That is our differentiating factor.
Okay. Sir, with your solar plant installation, what percentage of your energy requirement will shift to renewable sources, and how will this impact long-term cost structure?
See, right now we have applied for a connection of about 1300 kilowatts, or say near about 1.3 megawatt. Okay, that is a normal connection, electricity connection, not solar one. Okay, this is because there is till now we had connections lower than 1 megawatt. So we, first of all, the saving that we would be doing is that we are going for a private buy and sell of electricity model. Okay. So there would be electricity saving. Along with this, at least I think around 400 kilowatts watt of solar installation we are looking for, that has come up after analyzing. So roughly around, you can say 20% of our demand would be met by solar energy. And that is not due to the capex involved initially or anything. That is purely based on the 400 kV that has come out. That is purely based on the technical feasibility. So what percentage it would be? Around 20%.
Okay. So one last question I have is that with the B2B digital platform and expansion into e-commerce channel, what shares of sales do you expect from digital initiatives over the next 3 to 5 years?
That is too soon to say. Reason being, like I said, that is under development from last 6, 7, 8 months. But our primary focus is for right now is B2G segment, because we have gained a good traction in that, and I see a huge potential in coming 1.5 years from that segment. So maybe I can get back to you on this after say 2-3 weeks, because I'll have to analyze that.
Yeah, sure, sir. Not an issue. Yeah.
You can connect with Kirin and then to me. We'll have a chat about it. Okay.
No, sir. Yeah. Thank you, sir. That's it from my side. I'll join back with you if I have any more questions.
Sure. Thank you.
The next question comes from the line of Vinod Shah from VS Ventures. Please go ahead.
Hello. Good afternoon, sir.
Good afternoon, Vinodji.
Sir, I have 3-4 questions. So,
yes.
How do you expect the recent registration with Ordnance Factory Board going forward in the next 2-3 years and the first HAL order?
See, not first HAL order. Right now we have second HAL order in pipeline. We have supplied to NTPC few orders. We have supplied to BHEL, Bhopal or Indore, someone. Okay, and then right now I think we have one more from BHEL Haridwar. There are numerous orders that we are processing. Okay, though the percentage revenue this year would have been, till now, would have been around 1 or 2% only. But these registrations give us an access, a credibility, to boost these sales in a very faster manner. To be very honest, the traction in the B2G segment or defense segment or power segment is going faster than I expected. It suddenly happens that we are getting tenders, and right now also we have bid for huge tenders. If we get those tenders, because I am very positive about it, because what has been happening is that we bid for the tender and we somehow are getting easily, because most of the tenders that we are doing are concerning the specialty steel one. There is some kind of a special alloy or something, which we think to be easy because we have been doing it. but I think the offers don't come easily in those tenders. So that is one advantage that I have just recently realized in last 2-3 months. So the traction should be very good. Now I am quite confident that by next financial year, we should be supplying a good percentage to B2G segment.
So what percentage of revenue we are targeting from B2G and defense going forward?
I think next financial year, we could reach around 10% from B2G segment.
And what are receivable days in B2G and
because till now we are in the MSME category because our turnover is below 500 crores. Now the norms have been revised. So we fall in the we fall in the MSME segment. So maximum to maximum it is 60 days.
Okay, 60 days.
Okay. It is by the norms it is 45 days.
Okay.
They have to pay us within 45 days if they are procuring from MSME segment. That was a norm built like 2-3 years back by the Ministry of Finance. But practically we are seeing that we are getting in 45 to 60 days.
Oh, not much different, but much time.
Yes. Yeah.
So, on new facility, what is the estimated timeline on that, and what kind of efficiency and margin expansion we can see?
Sorry, I didn't get you. The voice got cracked.
Sir, what is the estimated timeline for our new facility, and how much incremental capacity, efficiency, and margin?
We'll be starting the construction phase should be completed by December end maximum. Okay, and by January we would be starting shifting of one of the units as well as installation of the furnace for the new GI thing. Okay, and I believe it should be fully operational. I mean, it would be fully operational by March. But after post shifting the second unit as well as everything done and dusted, it should be by July next year.
Okay, July. Okay. And how much savings can we expect from this?
Minimum 2.5 crores annually. Minimum 2.5 crores.
And that would be from July onwards.
Yeah, I am not including the financial savings in this, like the interest cost reduction, but operational as well as administrative, all these for electricity, these all costs should be saving us minimum 2.5 crores.
Okay, great.
Overall, I think with interest and everything, it should be 4 crore plus on a lower side.
Okay. That's all, sir. Thank you so much.
Thank you.
The next question comes from the line of Ishpreet Kaur from Relax Capital. Please go ahead.
Hi, thank you for the opportunity. We just wanted to understand from a very longer term perspective, is there a possibility to add some more product segments, or you see addition of new industries? Just to understand what is the kind of vision that you have for the company from a very long term perspective.
From a very, very long-term perspective, I want our company, like I said in my speech as well, that it should be a company that should be positioned in a way that is known for its innovation. We were a hardcore commodity business like 5-7 years back. Then we introduced like alloy steel, stainless, some items that were specifically tailored for the customer, engineered for the customer. So from there, that transition has happened. And now the next transition that I see, the main reason for going behind this power sector and the defense sector is that we would be focused towards R&D and producing those products which align with our, somewhere align with our existing products. But ultimately, we should be developing those products which no one else is doing in India, and we should be able to either substitute the imports that the B2G segment is currently doing, or we should be able to even go beyond that, producing some things which are innovative, and we should be, having certain kind of patents and technologies which Maiden should only have. So that is our long-term vision.
So Could you also quantify as to the stainless steel products is how much of volume and value as of
Right.
now?
Right now, the quantum is about 15% in terms of volumes, like quantity sold. Last year's data I am telling, about 15%, and the revenue contribution is about 40%.
Okay.
Because the value is 5 times, like SS is 5 times of carbon steel. That is why.
Okay. And could you also help us understand the operating profit difference? Like you mentioned, the sales is like 5 times a difference between stainless steel and carbon.
Right. See, in carbon steel, the average would be around 10-12%. Carbon and alloy combined. Okay? Average.
Okay.
And in stainless steel, it is bare minimum of 18-20%.
18 to 20%.
Operating profit. Right.
Right. And the 15% volume share can increase to how much, say 3-4 years down the line?
It can increase to up to 40% also. But like I said that right now what we have done is because markets have gone very, very dynamic. Today, if you want to make extra profit, extra earnings, then you will have to provide to your customer what the current demand is. So it's not like currently I am seeing that more than stainless steel, like common grades are 304, 316. These are common grades in stainless steel. Okay, but
Right.
Let's not go for that, but go for a lower alloy kind of grade of stainless steel. Let's say 430F is one of the grades. Okay, that requires some kind of a speciality in terms of the treatment, the quenching, tempering treatment that is being done. And we have realized that there are very, very few limited suppliers for those grades. Okay, so we are focusing on them because they have requirement in more critical applications.
Correct. This is
So
which
we
grade
are-
you mentioned? Sorry?
430F. 430. Yes. Like, I talk about 316 is a grade whose, I think, average selling price for us would be 320 rupees. Alright?
Right.
But, and raw material price would be around, say, 270 rupees. Okay?
Okay.
So, I'm just giving you an example. So,
Right.
But 430F raw material is only 125 rupees per kg.
Okay.
But it can be sold for 170
Okay.
after all the treatments and everything. Okay, because the availability is scarce.
Correct.
So we found that there are certain items, certain grades, certain end products that have a shortage in terms of supply or in terms of quality supplier. So that will help us, very much like where we want to go, that is to develop products that are tough to develop. So that gives us, helps Maiden in building that kind of a brand. So we are more focused towards those grades right now.
Okay. Could you specify as to what TAM could this be, I mean, total addressable market for this 430F? You're already doing some part of the stainless steel.
It's huge. I mean, I have never analyzed, but because we have been catering to this market from 4-5 years now. But recent times, since we were also looking for, entry into all the other sectors that we were not active in. So then we realized that these have a huge market, but they don't get suppliers. There was a gap. There is a huge gap in, the person who is requiring the materials, they are not able to find the right supplier, and the suppliers are not able to find the right market. That was the case with us as well. So now I think we have found the right market.
Okay. And with these orders of the ordnance factory and the approvals that you've got, are the margins any different for such kind of orders?
Definitely. If the application is critical, the quality parameters are critical, then definitely the margins could be there.
And would you be able to specify in what range can they be?
I mean, it's tough to say what would be the margin, because if we are selling some alloy which is 60 rupees basic raw material, we can easily sell it for excluding GST for 90 rupees.
Okay. Got it.
That is
And
the case. So you can reverse calculate.
right. Just lastly from my end, the new facility, so our existing capacity is 53,000 metric tons.
Yes. With the new added one, it would go around 62,000 tons.
62,000 metric tons. Okay.
Right.
Sure. And there would be space for further expansion in the existing,
For next
in the new.
5 to 6 years, we won't require any other location.
Okay. Sure. And this 62,000 metric ton and on a full revenue potential can get us how much revenue?
More than 700-800 crores.
Sorry, 700-800 crores.
More than 700-800 crores.
Great. Thank you so much.
Thank you.
Thank you.
Thank you.
The next question comes from the line of Rahil Sheikh from Sapphire Capital. Please go ahead.
Hello, am I audible?
Yes, Rahil, you are very much audible.
Yes, hi, Nishant sir. Good afternoon. So just a very, basic question on the outlook. If you can share something about, our future prospects when it comes to revenue guidance and margins outlook. So I've been seeing past few quarters in the year has been flattish, and now we're on this expansion mode.
Past 3 half years actually.
And
past half years.
Yes.
Past 3 half years. Yes, not quarters. Right.
And so now, just a kind of, the roadmap ahead, if not exact percentage with growth, but just, management's, vision and aspirations when it comes to what kind of numbers we can achieve, one can pencil in, and what you are expecting from the market. And also on the margins regards, please, given this new addition of the B2G in the defense. So if you can draw out a map for us for the future, please. Thank you.
So Rahilji, first and foremost, for this particular H1 financial year 26, I have already told that the steel price is so decent that despite having highest sales in terms of pure quantities and volume, we are still getting a marginal kind of growth in the top line. So that is the biggest factor that has added to this. Otherwise, we reached around 17,000 tons, which was the highest in 23-24. In the complete year, we did about 34,000 tons. Before that, it was 29,000 tons annually, 34,000 tons. So in the H1 itself, we have achieved 17,000 tons. Even that year, it was around 15,500 tons. So the volumes are increasing, which is a very good indicator for us that, okay, we have sustained orders. We have got, in fact, growing orders. So that is, as a MD of the company or as a part of management, that is a very good sign for me because this is cyclical and the prices are bound to happen if we even maintain these quantities. We are going for, aggressively for increasing the volume. But even if we maintain, let's take an assumption, even if we maintain, even the cyclical correction will improve the revenues to a great extent. So that is first and foremost regarding the past performance. Now coming to the future vision. I believe for Maiden Forgings, the kind of a jinx that we are stuck from last 3.5 years, or even I would go beyond that and say last 3 years we are stuck at similar kind of revenue level. But I see a huge potential in the year 26-27, which will give us an excellent growth with the new facility in place within the first quarter itself, with the 2 new products which already have pre-built demand for us. So 26-27 would show us the true picture. Even as a management, it will show true picture, and we believe it to be a very bright year for us as a company, as a management. So I expect that there should be a phenomenal increase in this financial year, completely. And post that, once we get that kind of traction with everything that we have already talked about, covered in the in my opening remarks, as well as the previous questions that previous callers asked. So what all I have covered. So once these things have already gained traction, it would be a simpler thing to even double down the revenues in the coming 3, 4, 5 years. It is very, it should build, the momentum should be built, and within next 4, 5 years, the growth should be phenomenal. I mean, I am very positive about the future outlook of our Maiden Forgings. Hello.
Does that answer your question, Rahil?
Rahil?
Are you there? Since there's no response from the participant,
I think
next. Yes, sir. So we have a next question from the line of Mayur from Tijori Capital. Please go ahead. Mayur, please go ahead with your question and unmute yourself in case if you're on mute. As there's no response from the participant, we'll move to the next participant. The question comes from the line of Priya Jain from Kirin Capital. Please go ahead.
Hello. Am I audible?
Hello.
Yes, Priya.
Yes.
Sir, I'm new to the company.
Hello. Again, there is disturbance.
Yeah. Can you elaborate on the expansion, like as a bright bar?
There is some problem with the voice.
You're breaking up.
Can you
Could
please
speak
check
a little louder?
Yeah.
Please use your handset mode in case if you're on the speaker mode.
Yeah. Can you elaborate on the expansion of high margin product lines like SS bright bars and coils, nails, and how they will shift the product mix over the medium term?
Not just stainless steel bright bars or pneumatic nails, but like I said, by the next H1, we would be starting with GI wire as well as stainless steel components as well. So these two products have even better margin than the existing ones, the two you named. So in the next financial year, definitely there would be increase in the margins, especially after the cost saving and everything, and these products would be contributing a good amount to the overall revenues of the company.
Okay, and
I'm not going even mid-term, I'm just going for the near future, and that is the next financial year.
Okay, good to hear. Also on export side, currently, if I'm not wrong, export currently contributes to 6 to 8 of product sales. What is your strategy?
Right.
What is your scale international business, including warehousing plans in overseas markets?
Right. See, right now we are, on the verge of breakthrough from the Gulf channel. We see that there are huge cost savings in terms of transportation and everything if we route our things via the Gulf channel. And like you are already analyzing multiple companies, the bigger companies have already adopted this model during last 1, 2, 3 years. So that channel we are exploring, and we are on the advanced stages of that. So maybe there is a good news from that side. So that would be the strategy, because this entire testing and everything that was going on in the past 6 months, that has impacted our exports a lot in last 6 months. Like even the orders in hand, specifically for US. Europe ones are already going. But the US ones, they were kept held for like 3-4 months back to back. So we think to mitigate this risk that is going on in the global market, we need a separate channel as well. So that is why we started exploring this, and we are quite positive that this should also enhance our export sales within a coming year or so.
Okay. Also, when I look after the stuff, you are supplying to Hero, Bajaj, Maruti, even
to the OEMs of those. Our product would never be used in Hero or Bajaj directly. It would be used indirectly.
Okay.
Right. We will be supplying to the tier 1, 2, 3 kind of customers over there. Hello?
Does that answer your question, Priya?
Yeah. So again, all those are like Hero, Bajaj, Honda, and Maruti.
Right.
All are tier 1. So how do you plan to deepen this wallet share and strengthen this long-standing relationships even you are supplying to the OEM?
See, that there we have a good network because that is our, for me, it's a kind of parental business. We have been supplying to these, to the OEMs of these brands since 91 or 92. So there we have a good networking. We can expand as much as we want. But that being said, there the products that are being used are not are no more very much specialized. They are commodity-like products. So that doesn't give us a huge jump in terms of margins and everything. That is why our focus is towards the newer sector. Because we don't want to be a commodity-like business. We want to supply something which is specialized. And we are already producing those products and have capabilities to even develop more of those. So that is why our primary focus stands today at the defense and power sector or infra sector. These are the 3 sectors that we are targeting right now. We are like auto sector sales is increasing on a day-to-day basis on itself. We don't need to give any special attention to that segment to increase sales.
Great. Good to hear. And I think that is from my side. I look forward to the next podcast.
Thank you. Sure. Anytime. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Harshil Ghanshani for the closing remarks.
Yes. Thank you. On behalf of Kirin Advisors, thank you. On behalf of Kirin Advisors, thank you for joining the conference call of Maiden Forgings. If you have any queries, you can write us at either research@kirinadvisors.com and info@maidenforgings.in. Once again, thank you for joining, everyone.
Thank you, everyone.
Thank you. Ladies and gentlemen, on behalf of Kirin Advisors Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.